Welcome to Energy Unplugged, the go-to podcast addressing the global energy transition. I'm Weije Mark, head of Aurora Australia. On today's episode, we'll be discussing the investment landscape in Australia for power and renewable assets. Delighted to be joined by Harrison Moore, one of the most seasoned pros in the industry to be discussing this topic. Harrison is currently a partner at Azure Capital, Australia's leading corporate advisory firm, particularly in the energy and natural resource sector. So Harrison leads Azure's Energy and Renewables advisory practice and has played an active role in helping with a lot of the existing renewables and battery financings, including Waratah Battery, which is one of the largest batteries in the Southern Hemisphere. Harrison, welcome to Energy Unplugged. Absolutely delighted you can join us today.
Thank you, Mark. Thanks for having me.
We are also joined today by Laura Perez del Olmo, an associate within Aurora's advisory team, who will be helping with facilitating this discussion.
Thank you, Mark.
Before we get into the session proper itself, a lot of our listeners here will be from overseas. So maybe we can turn to Laura first. Laura, could you maybe give us, at a high level, some of the basics of the Australian energy market, both on the East Coast and the West Coast?
Sure. So in Australia, there are two major grids. There is the National Energy Market, what we call NEM, which is an energy-only market, and it operates on one of the world's longest interconnected power systems, connecting the 5 eastern states: Queensland, New South Wales, Victoria, Tasmania, and South Australia. Coal is still a dominant technology, and it makes up about 50% of the grid-connected generation. Wholesale power prices are, almost by design, very volatile. The price floor is set at minus $1,000 per megawatt hour, whereas the cap is expected to rise to $20,000 per megawatt hour by early next year. It is this volatility that incentivizes new generation. On the other hand, the wholesale energy market, or commonly known as WEM, is about 1/10 of the size of the NEM and is in the West Coast. It's about 20 terawatt hour versus the 200 terawatt hours of grid demand. Similarly, it is still coal dominated at the moment. One of the key differences is that it operates with a capacity market alongside the day-ahead and the intraday balancing wholesale markets. Because of this, wholesale prices are much more muted, with a cap of $1,000 per megawatt hour, or 20 times lower than that of the NEM.
Thanks, Laura. And I might turn to you, Harrison, to talk about the investment landscape in Australia. So we are actively seeing a lot of interest in the market. Our Australian advisory team probably works on something like 15 to 20 projects a month. What are the key thematics that is making Australia so popular amongst investors?
Yeah, thanks, Mark. So there's a strong governmental and regulatory support within Australia. So government targets around emissions reductions within the sort of the near future, and also all the way out to net zero by 2050. There's a number of government support programs, including capacity bid tenders that are ongoing across the NEM as well as the WEM. We're seeing coal retirements, and they're still a big part of the electricity network, and there's new generation, new storage to support that generation that's going to be required over the coming decades. And that's in a market that is growing in terms of electricity demand. And so we continue to see the need for capital and investment in this sector. And, Australia's been a relatively stable part of the investment landscape, and there's a deep pipeline of projects, experienced developers, and a growing number of secondary market transactions, which creates an opportunity both for investors investing in sort of early, mid, late stage projects, as well as those looking to invest in later stage brownfield or operating assets as well.
Thanks, Harrison. And yeah, I mean, government stability is obviously quite an important theme in today's world. We'll circle back onto that question or topic shortly. But maybe in terms of interest, you've mentioned that the NEM is still very coal dominated at the moment. It's something, like 50 to 60% of utility scale generation is still comprising of coal. and probably a larger scale in the WAM as well. So as we have to close all of these coal assets, there's obviously a need for new investments in renewables and storage and potentially gas assets. Now, in terms of the technology mix, what's the current interest amongst investors at the moment? Is there any clear technology that stands up?
Yeah, it's definitely batteries is the preferred part of the market at the moment. And part of the reason for that is, we've seen huge investment in solar and wind generation assets, which, they'll continue to be is an important part of the energy mix. But without batteries, that's not a sustainable energy solution. And so increasingly we're seeing, batteries sort of be at the forefront in terms of investor demand. And that's both on the equity side as well as the debt side. And in the ready to build part of the market is really where we've seen the majority of interest. In terms of the scale, it's utility scale investment opportunities that's where the majority of capital is getting spent. There are a number of investment opportunities for distributed scale assets as well, things which are sub 5 megawatts, but it's a much smaller part of the market. There's harder to scale. And so whilst we are seeing some opportunity in that space, it's not quite as active.
Yeah, and like in terms of batteries, utility scale battery assets, we often get asked by clients, what is the duration of these assets that the market is most interested in? Azure and yourself have helped finance many of the shorter duration assets, but also increasingly this longer 4 hours, 8-hour assets. Is there a preference in the market? Is it shifting away from shorter duration assets towards this longer duration assets?
There's definitely a transition happening towards longer duration. I'm not quite sure it's happened yet. 2 hours duration still seems to be the prevalent choice in talking to investors, but increasingly we're seeing people look at longer duration, 4 hours. Often there's some form of government support in relation to those longer duration batteries, though we're starting to see the sort of the commercial private offtake market catch up there. Ultimately, it's just determined by economics, right? And when the market mechanism and incentive is there to invest in longer duration, then we'll start to see that happen more prevalently. And generally our clients are expecting duration to continue to get longer. The market's probably just not quite there at this stage.
Perfect. And you mentioned earlier kind of renewable investments is keeping a pace, and that's why there's a lot of interest in battery assets. Now, what we're hearing from clients, if you're thinking about kind of early site selection all the way to commissioning, we're looking at probably like 7 to 8 years for wind asset and 4 to 5 years for solar asset. What's the landscape like for renewables? Is it as challenging as what we're hearing from clients?
Yeah, definitely. I think the securing the land is really just the first part of the journey. And often you're dealing with multiple landholders, stakeholders to even get to that stage. But then, the development approvals, the regulatory process that you have to get through to actually get a project to the start line and into construction can be quite a long and arduous process, particularly for generation assets, wind and solar assets. We are seeing the development pathway for storage assets are a lot shorter, smaller footprint on which you're looking at, often located in an industrial area or close to an existing substation. And so that there may be a quicker pathway to actually get a project through to the start line and into construction, and less disturbance, and I guess a growing demand and need for those assets as the energy system transitions.
Yeah, and with batteries, you mentioned that ready-to-build assets were probably most popular. What about renewable assets? Is it similar stages of development, or is there interest in earlier stage developments of these assets?
Yeah, there's a real mix, I would say. So, we continue to see appetite, across the development life cycle of an asset, from early to mid to late stage ready to build assets and operating in brownfield. But in a return environment post the interest rate hike cycle of a couple of years ago, we are seeing a greater focus on returns and yield. And it's meaning that investors are sort of going to a slightly earlier stage in an asset's life cycle, and we'd probably see peak liquidity for assets that are at that shovel-ready stage for the most part. And then there's different mix. So the kind of investors that we're seeing invest in operating assets are often different to those that are investing in early stage assets, which are up the risk curve.
Yeah, and who might some of these investors be? Well, what are the kind of typical investors that we're seeing in this market?
Yeah, there's a real diverse range of investors. So that's strategics, whether that be the gentailers or developers. We're also seeing financial investors. A number of those have built their own sort of IPP style investment platforms. Some are just building out businesses or direct investments into assets, and generally they're managing superannuation or pension fund money, and that's both domestically and internationally. And so there is quite a diverse mix. In terms of investors coming from overseas, we see a lot of investment out of Europe, from the Asia Pacific region, and then to a lesser extent, North America. But there's plenty of international demand for investment in Australia in this sector across all stages of development.
Yeah, and do you find that there are more, we've seen in Australia kind of, there's a lot more like kind of growth in like portfolio deals. Is that what kind of investors and clients are looking for? Is there still a lot of interest in single assets financing and kind of M&A transactions in that space?
We still see demand for single assets, but often part of that is, is this an asset that I can acquire and then look to add other assets to or build a team around? So you're right, I think, to observe that increasingly there's a focus on follow-on investment and opportunity and the capacity to build out a platform, or if it is a single asset, bring that into a platform. And part of that is diversifying risk and exposure, the ability to extract synergies from complementary technologies, whether or not that be through things like portfolio financing or the capacity to write contracts, offtakes that involved multi-technology. Increasingly, we're seeing that sort of part of the strategy that investors are looking to deploy. And I think you'll see further consolidation as more and more parties look to build out platforms in the market.
Yeah, and definitely, we're definitely seeing consolidation as a theme in the market as well. Maybe on, kind of investments, optics are obviously quite an important part of making an investment decision. We're getting quite a mixed message from clients, I guess, in terms of the availability of offtake agreements in the market at the moment. What are your sentiments around, the availability of PPAs, for renewables, but also for battery assets? Are there a lot of them going around? Is it quite challenging to be securing an offtake in the market right now?
Yeah, there's plenty of offtakes in the market. There's just a question of price, which then ultimately drives liquidity. What's the clearing price for offtakes? And then what does that mean for the economics of your project? And, I would agree with the sentiment of some of your clients around that being challenging in some states in particular in Australia, and some technologies in particular. On the generation side, with wind and solar, we've seen the cost of things go up quite materially, particularly with wind assets. And so the incentive price that's required on an offtake to actually get that project into construction, is relatively high. And there's a bit of a lag effect in terms of, that price hike on the CapEx side, how that then flows through for energy prices and potential offtake that goes with that. Similar in solar, you contrast that to something like batteries, where there's a lack of investable opportunity. It's a relatively nascent market. I'd say there's a lot more liquidity across, batteries, but again, it's different state by state, and there's more and more developers bringing batteries to market, creating more competition for those offtakes. But at the moment, I'd say there's a bit more choice if you're a high quality developer with a battery, which is at a late stage, and the ability to navigate construction, get it into operations.
And coming back a little bit on the government support that you previously mentioned at the beginning, Australia, particularly the East Coast, is a wholesale-only market. Recently, the government is trying to unlock investment in renewable generation and storage with tenders such as the Capacity Investment Scheme, as you mentioned, which for those that aren't that familiar, it basically employs a cap and floor mechanism where you bid a floor and ceiling, and there's a sharing of both upside and downside risk. Could you give a sense of if it has actually helped to financing assets and how it has helped?
Yeah, it definitely has, is the short answer. There's probably a smaller group of assets that have relied solely on government support through one of these tender processes, and there's been specific, I guess, requirements that those tenders have supported, but it's often part of the offtake or the contracting mix. And that helps support investment in longer duration, as I was saying, helps support investment in a new and emerging sector in the Australian market. And with the Capacity Investment Scheme, by way of example, we're seeing that as part of the offtake and contracting strategy. We're probably not seeing that as a standalone solution. So it's helping effectively catalyse investment in that space by underwriting part of the risk for investors to enable sort of further investment in the space.
There has been recently, as most of our listeners will know, we had recently had federal elections where we saw that the 16 Labour government secured landslide victory. What, if any, difference might this entail for investors in Australia?
Yeah, I think it will be certainly helpful in terms of continuity in government and policy and endorsement really of the energy policy, which was sort of a major topic at the recent federal election, reaffirms existing targets in terms of renewable energy transition in Australia, and just provides, I guess, further clarity for investors around what the next period of time looks like. We have obviously seen in some other states in Australia a change of government. It has meant some uncertainty around some of the policy settings that have otherwise been supportive of a transitioning energy system and the build out of renewables. And so I think from that perspective, it will be helpful for investment, albeit, it's only for sort of the next term of government, and investors are trying to make decisions for the long term. And this asset class is 20, 30 plus years. And so you need to have a view sort of beyond the current government election cycle.
And moving now a little bit more globally, we are seeing an increasing uncertainty investing in the green energy transition. For example, in the USA, we've got Trump's One Big Beautiful Bill, which could effectively repeal a lot of the IRA. Any implications of this in Australia?
Yeah, it's probably a little bit early to say in terms of direct flow-on impacts, and particularly coming off the back of the federal election, where I think we've seen, call it an endorsement of the existing government's energy policy, which is to keep going in terms of transition and the build out of renewable energy technologies and battery energy and other storage technologies. In terms of what the potential unwind of parts of the Inflation Reduction Act might mean for Australia in the short term, it's created volatility, certainly with some of the other policy settings coming out of the US, for FX, for rates, for other things. We haven't yet seen further impacts in terms of potential capital flows out of the US and potentially into Australia or places like Australia. So there could be some tailwinds coming there, but it's a little bit early, I think, to say at this stage in terms of what the implications might be of that policy.
Yeah, and I would add as well, like some clients are actually slightly positive in a sense. You've mentioned, Harrison, earlier that solar and wind capex in Australia actually has continued to stay quite elevated despite some of the more broader global trends. And we're hearing from some clients, less solar panels to the US means more towards Australia. It could be a positive to the Australian market as well. Yeah, so maybe, Carl, we've covered quite a bit in the last 20 to 25 minutes. I've got maybe two more quick rapid fire questions here. I think the first of which is, we've talked a lot about kind of your views on the current investment landscape. Now, you have obviously successfully helped with advising many clients on both the buy and the sell side. So two sides of the coin here, I guess. What have you seen being some of the main attributes that makes, a potential sell side very attractive to buyers? And on the other side, other than the price, what might some sellers be looking for in potential buyers coming into the market?
So different investors sort of are looking for different things, but as a general observation, we're talking about infrastructure investors, that are typically looking to make long-term investments, and so they're looking for certainty in their investment, and that's across the cost of things. So, what does the capex profile look like? Is this an EPC wrap? Are we talking about a split scope contract? So that risk allocation piece is super important. What does it look like in terms of my revenue profile? Do I have certainty over the long term? Is there some merchant exposure? Maybe a little bit of that is a good thing. And then what underwrites my capital structure? And so what we're looking for, I guess, when we're taking on a sell side mandate is what underpins, I guess, a typical infrastructure investment and return, and what we think is going to be helpful in terms of positioning and marketing that asset. And it's really about providing certainty for investors, as well as the opportunity to be exposed to potential upside whilst mitigating that downside risk. And so it's never just one element, and no two targets or investment opportunities are ever the same. But yeah, it's all of those things that come into play about a specific opportunity that we might look at.
Perfect. And maybe one last one from me. We get asked by clients a lot when, especially our overseas clients, when they're looking to invest in Australia, what are the kind of typical reading materials or resources that we might recommend? So if I were to ask you the question, I guess, if someone was looking to understand more about investing in the Australian energy transition, what resources would you recommend listening to or reading?
Yep. So aside from everything from Aurora, of course, whether or not that's the podcast or their market materials, I'd be encouraging people, to talk to people that are active in the market. So that's financial advisors such as myself, my peers. It's talking to project finance banks, other investors in the sector, the broader suite of advisors, whether or not that's legal, insurance, tax, etc. There's also a lot of good reading material that the Australian Energy Market Operator puts out. There's various other sort of good sources of material sort of in the media. That there are some energy-specific news services, and the kind of the financial press as well. So there's quite a few good resources at your disposal, and I'd say we often see, a period of 6, 12, 24 months of investors educating themselves on the market before they're actually ready to start investing.
Perfect. Thanks, Harrison. Thanks so much for your time today. We've covered a lot in the last 20-25 minutes, and we're incredibly appreciative of your time. All the best, and thanks again for coming on Energy Unplugged.
Thank you for having me.
And thanks to Laura as well.
Thank you, Mark.
That was Harrison Moore, Azure Capital's head of Energy and Renewables, talking to Weije, head of Aurora Australia, and Laura Perez del Olmo, an associate within Aurora's advisory team. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow the podcast via whatever platform you use.